this idea that equities can't rally with the yield curve inverting is not necessarily true. I know we don't cheer for an inversion. I understand what the ramifications are. But if you look at the last 5 inversions going back to 1970, in 4 cases, stocks actually went on to rally for at least a year into the onset.
Right. He's right. We pointed that out at the time. The day of the inversion, we were saying it doesn't mean like all of this.
So I was on that day. It's an average of 15% gains for the stock market. And I don't know what the fundamental reason for that is. I would just suggest that historically, we had not been following the yield curve as closely as we follow it now. We're about 5 minutes from CNBC putting a box above the right-hand corner where they put the S&P 500. You're going to have like an inversion, and it's going to say how many basis points. Look, if you don't think we're going there, remember when gold made a new all-time high. Gold had a permanent spot on CNBC. Oil, the same in 07 and 08. Bitcoin. So that will happen at a certain point. Maybe it's after the yield curve has inverted and stays inverted for a week or 2 weeks. But this is going to Joe's point, this is now going to dominate not only sentiment and the way we talk about recession, it's also going to dominate the way software programs that are being written to trade this market are going to behave. And I just think we need to be aware that it's not normally a good sign, but also we should be aware there's something called the Heisenberg uncertainty principle. Something that's being observed is going to act differently than when it's not being observed. And we are all so focused on this yield discussion, it's possible that we are talking ourselves into something that doesn't end up happening.
Then Oppenheimer today says the sell-off is way overdone. And I mean, they literally spell out way overdone to make the point that stocks got too beaten up.
We're only 3%
because of
off
what
the
was
highs,
happening
though.
with yields
How
in the
can you say
inverted
that?
curve.
Yeah, we're only 3% off the high.
Off the high at one point. I don't think it's way overdone. We have a lot more some stocks.
I've had a
like
nice comeback in the last 2 days.
The Caterpillar, but even at the bottom, this sell-off wasn't 10%. This sell-off was half of that. But, you know, some of the Caterpillars, the Deeres, et cetera, they're pretty oversold, justifiably so. Look, the facts are that we're still prisoner, and I'm not saying we shouldn't be, to the old thinking, which is that when you have yields come down the way they are, it presages economic slowdown. The curve wasn't inverted long enough to predict a recession. That's only 50-50. My view is that that textbook still hasn't been written. Negative rates around, you know, in the sovereigns around the world are now, you have 20% more sovereigns yielding negatively than you had just a few months ago. So there's this drive for yield. And as those instruments roll off, you'll see the U.S. Treasuries yields go lower still.
If you knew that, and just playing into the theme of Jackson Hole this week, if you knew that global central banks were going to do, to borrow Draghi's comment from a few years ago, whatever it takes.
Right.
You know they are. They're going to at least try. Whether they have to say those words explicitly or not, then the risk is getting too negative because central banks are going to be all in, so to speak, if they have to be.
So that's right. And then to tie that in with Josh's point, but I guess because I can't have him let him have that one. You mentioned that stocks do rally even though yield curve is inverted. It's true. They rally over the next 12 months. But what I was saying is that over the near term, it's very difficult for them to rally. Why they ultimately rally is because the Fed recalibrates the policy. And this gets me back to the point on Jackson Hole is the Fed cannot just idly sit by and let the economic data globally slow down and let the Trump tariffs threaten further the U.S. economy and see the yield curve where it is and not do anything. So my base case is that sometime between now and September, they will likely acknowledge the risks that are building to the economy, whether it happens at Jackson Hole this week or not. But I think ultimately this is why we want to be buying this dip in August for September.
If Trump said no more tariffs tomorrow and actually meant it, fired Navarro, are we then too easy? Are we back to the Fed has to tighten? Or have things permanently for this cycle slowed in the global economy where only U.S. central bank stimulus brings us back from the brink?
Look, a lot of damage has been inflicted on the global economy over the last year. I mean, you look at global PMIs, and it's not just about one more incremental tariff. There's a big hole that we have to dig out of. I mean, this morning we were talking about Germany adding fiscal stimulus. So I don't think we're all that easy.